Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, in the last week, a lot's been written about home equity lines of credit, debt, increasing in Canada the last couple of years. Is this a big problem?
Is it a big problem? It's a big problem because we look around at the number of so-called experts and prognosticators and social media stars that are going around talking about home equity lines of credit as if they know what they're talking about, as if they know the historical context and use of home equity lines of credit by the Canadian population, Canadian homeowners. And it's clear in the assessments that they make, Jim, that they are clueless to how Canadians interact with their homes and their home equity. So when we see a rating agencies come out and criticize Canadians as being not prudent with their money, of being spendthrifts, of just throwing money around without care because they can access it through their home, it just defies logic, and it defies how people interact with their homes. And the fact that Canadian banks don't come forward and explain to Canadians the myths that are out there about home equity lines of credit and the amount of debt that was recorded in the 2017-18 period and why it peaked, it really is just insulting to their customers. Now, I understand that Canadian banks do not want to disclose the amount of HELOC debt that their own customers are accessing, when they access it, what they're accessing it for, what interest rate they're paying, or anything else, because they believe they have a competitive advantage against the other banks when that information isn't shared. This is the same underlying problem that the Bank of Canada and the OSFI has, trying to get the banks to disclose their mortgage debt portfolios, which Canadian banks refuse to fully expose to the oversight of the OSFI and the Bank of Canada. So the Bank of Canada is left instead to guess. Now, it's an educated guess because there is some reporting, but it's not a thorough one. So they have to make assumptions. Assumptions become opinions. Opinions become falsehoods. Falsehoods lead to problems, which is what you're reading right now with anyone who's been publishing something about home equity line of credit debt since the latest reports have come out. Number one, Equifax and TransUnion sole business model is the creation of your credit scores. Equifax created your credit score. Their entire business is built on selling banks your credit score. Why? So that the banks can charge you the highest interest rate possible when you're borrowing money from them. Anyone who thinks that these credit scores are designed to benefit the consumer is clueless. These credit scores were created by TransUnion and Equifax to establish a way for them to monetize rating the borrowers of money, which in turn the banks use to charge you the highest interest rate they possibly can. They are now going after the line of credit debt, and you have Equifax and TransUnion creating clickbait reports, clickbait headlines that are quickly seized upon by mainstream media realtors, housing bears, anyone that wants to find something negative to say about the housing market. Now, at that long preface, Jim, let me explain to you what happens with home equity lines of credit in a trading cycle. You would fully expect, when you are reading local real estate boards are reporting 10, 15, 20% year-over-year gains in house prices, that the current group of buyers who are buying homes, their next home, before their current home has been sold. That means those buyers are going to need to access equity from their existing home in order to close on their new one. And at the peak of the cycle, when the market blows over, there are going to be tens of thousands of homeowners who sold their house in the spring market, who purchased their next home in the spring market, who wake up in May, June, or July not being able to sell their existing home. Their entire financial being is relying upon them closing on that next home. What do? The same thing that they did when they purchased the home without their existing home being done. They borrow money from their lines of credit. You would expect fully sometime between July, August, September, October of 2017 for home equity lines of credit to peak based on what I just disclosed here on the show. If you go back and you check the HELOC mortgages, the data that's supplied from the OSFI, you'll see that is exactly what happened. Not only that, you're going to see that it carried on through 2018. You also need to consider that residential property owners who believe in owning a piece of rental real estate, who purchased a pre-sale condominium, which came to close in 2016, 2017, 2018, you got a mortgage on that condo, but they also needed a down payment. Where did they get the down payment from? Well, that was simple. A home equity line of credit. Someone needs a new roof. You need a new roof and you get a contact from the builder. You don't have an $8,000 in your bank account right now because you've got your daughter in university, your son in college, and you need to budget for that. So you really can't spend $8,000 right now. So what do? You use your line of credit. The beautiful thing about a line of credit is it's the lowest non-mortgage debt that you're going to borrow. You are going to pay the lowest amount of interest on that debt than you will anything but your mortgage. If you have a substantial amount of equity in your home, it's very possible your home equity line of credit, it could be even less than what the interest rate that you're paying on the mortgage. So what we have here is we have a false sense of problem in the financial sector of our economy being espoused across the country by people who simply haven't studied how homeowners interact with their home equity and their home debt. That is exactly what has gone on. The sad thing is, Jim, if you had been able to track this back in the 1990s, when the last time a cycle crested the way that this one did, you would have found the exact same thing was going on. It has nothing to do with people being irresponsible. It's got nothing to do with Canadians spending more money than they should. What it is Canadian homeowners being smart. They're accessing debt at the lowest interest rate possible, which is a home equity line of credit. The foolish people, in my mind, Jim, is someone who has a credit card that has an amount on it, and they own a house where there's equity they could use to pay off that credit card. There's someone out there who didn't take advantage of borrowing money on their home through their home equity line of credit at 3%, which they could have invested with some financial advisor somewhere, and return 6%. And the interest that they're paying is also in those instances, tax deductible. Home equity lines of credit are a great way to make your mortgage or part of your mortgage tax deductible. Not a single one of these people who have been out talking in the public even mentioned that fact. Why? A, they don't know what they're talking about. B, they haven't studied home ownership. And C, the Canadian banks don't release that information. Home equity lines of credit, everything that you have read or watched in the news, anywhere that you've seen it over the last 2 or 3 weeks, is hogwash. It is a falsehood. It's the same falsehood that had people believe housing prices in Vancouver were increasing 30% year over year in 2016, or that housing prices in Toronto were increasing at 30% year over year in the spring of 2017. It's hogwash. It's a falsehood. It is propaganda by stakeholders anyone who profit from clickbait headlines by instilling fear, confusion, guilt in the Canadian public. It is so unethical that the way that they've talked about these things. We love home equity lines of credit at the Wealthy Homeowner and at Ross K. Realty Consult. For 30 years, my clients, when I was selling houses, loved home equity lines of credit. Home equity lines of credit have saved thousands of people that I know, hundreds, millions of dollars worth of interest over the years.
We'll have more with Ross K. right after this.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross K. Ross, the Bank of Canada keeps saying things are okay. Yet here we are 2 years after Canadian real estate peaked. And now, because of the declining value in homes, we could actually be in a recession, but they're not saying that we are. Are you seeing that bank data is being misrepresented when it comes to saying how much value Canadians have lost? And does that represent a recession?
I think the recession call we made on the show was well over 2 years ago now. I think it was March of 2017 is when we made the recession call here on the show. We measure recession. We measure recessions ahead of when the economists, the banks, central bankers record it later. Now, what I mean by that is that we are measuring a recession prior to it being seen. So we know that in GDP numbers for Canada, since the spring of 2017, March of 2017, the numbers that the Bank of Canada and StatsCan uses for GDP associated with real estate are false. They are trailing indicators. They are trailing indicators for many reasons. A, the stakeholders don't want to tell the truth because that puts them in a bad spot with their banks, i.e., there is no owner of a a real estate brokerage in Canada who wants their banker to know that their business is in trouble, that sales are slowing, that the number of people who are renting desks at their brokerage is going to decrease. Certainly organized real estate, RIA, with 120-some thousand members, does not want to do anything that will have members not renew their membership the following year. It'll be interesting to see the numbers in Alberta, because Alberta their renewal date there in Alberta just happened on, I believe it's September 30th was the last day the real estate agents could renew their license. They've seen falling numbers for the last 4 years. I expect this is the year where they really will take a hit. You have banks who clearly want to just keep stoking the fire no matter what they have to say to do it, so that their CEOs and their vice presidents and their presidents can get their bonuses. Yet we have regulators, central bankers, OSFI, who doesn't realize that this is what's going on. If you take out the false measure of positive economic gain from the housing market, which is actually not really happening, but it's because of false reporting on surveys, that's correct, surveys, not hard data, surveys. We have been in a recession since May of 2017. In other words, our economy has not been growing. It would have been, in a minor part, negative. The United States. We called the United States housing market in 2015. Now, we called it ahead of its turns because we said in this show for over 2 years, you have that kind of a lead time. So the American housing market ended up rolling over at the end of 2017, just as we had forecast, back in 2015. The American market, it's a little bit harder to forecast than the Canadian market because the data is not readily available here, but you can still do it. I mean, it's not really that difficult. Now you're hearing the consequences on the states. What did they keep revising previously good reported numbers downward. Right, because the old numbers you had were wrong. That's exactly what the Bank of Canada is relying on today. When the Bank of Canada is making a decision and they claim that the economy still seems okay, or that the housing market is supporting the Canadian economy, it means that they are not reading the data, because the data says totally opposite. Now, that said, do we want Bank of Canada to lower interest rates further? No. We would never give the Bank of Canada at this stage instructions or recommendations to lower interest rates right now. They are already at a ridiculously low level. Now, we would say you can lower interest rates if you raise or maintain the mortgage qualification ratio, the mortgage qualification rate used to buy houses. If they want to keep that high through legislation, in other words, instead of keeping it 2% higher, or the average of the 6 Canadian banks, 5-year posted rate, you want to say the average of 5-year posted rate plus 0.5%, or you want to increase the qualification rate to 2.5%. At the same time, you drop the Canadian interest rate 0.5%. There's no problem with that. That's no problem. You're not going to place the housing market as a risk to the economy. Because what the Bank of Canada doesn't understand, or doesn't seem to process, what I can't find in any articles, is that you need to have the ability to stimulate, refire the housing market. That means you've got to let the fire go out in the first place. Because when you put the newspaper back into the fire, to stoke the fire, to reignite the fire, to get things rolling again, you want to have the housing market or the stove as cold as it can be. If you use all your fuel, i.e. lower interest rates, which the banks automatically use to their advantage and they lower the mortgage qualification rate, causes a short-term influx in home buyers who then organize real estate, pretends as the housing market is going on forever again. The bankers say it's going on forever again. All the fear of missing out starts all over again. All the myths, the foreign buyer myth, the money laundering myth, all the myths that data debunks start all over again. And you don't have that much more to go. What the Bank of Canada is doing is they're listening to all these opinions of shareholders in the real estate sales business. trying to direct them for greater short-term gains. We are going to go through a recession sooner than later. The housing market has already signaled the recession is coming. The recession is here. We just don't know it. There is no sense not dealing with that reality. The sad thing is, Jim, the sad thing in this case is the Canadian government has had from 2012 till 2018, 6 years to build up a reserve of cash that they could have then applied to the Canadian economy when the recession hit. What did they do in the meantime? They kept spending as if the money wasn't theirs. They just kept spending as if they could spend till there's no tomorrow. Well, the day of reckoning is upon us. The day of reckoning will be here. We are not changing a single thing that we said about the Canadian economy since March of 2017. It will not change. They may squeeze out a short-term delay, but it's going to arrive. You cannot allow a housing market to go on the path that ours went on and not deal with the consequences. Canada did not experience a great house price correction that was needed in 2009. The reality is going to hit home.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, Calgary this morning had its real estate association claim home sales had risen 8% versus last August, and this came on a gain reported in July and June. Are they claiming 3 months of gains, and what should we be reading from these latest stats? Is real estate booming in Calgary again?
What everybody should be learning from Calgary, as we said here on the show for a while, Jim, is that market is functioning perfectly. Anyone who wants to study a housing market and gain some understanding of how a housing market works and how all the myths and falsehoods and cons have been delivered to the Canadian public since organized real estate first started publishing stats only needs to look at Calgary. And I'll use this example once again this month for your listeners. If in June 100 extra first-time buyers entered the Calgary housing market and bought homes, that meant 100 extra owners of those first-time homes that they bought are now homeless. That means that 100 extra owners are now home buyers. We would expect to see the following month 100 extra sales as those 100 extra first-time buyers bought their second home, their trade-up home. Then the following month in September, we would expect to see the third link in the chain, 100 extra of those buyers buy in September. Now, folks, what I'm saying is that those were 300 extra sales reported over 3 months that were only predicated on 100 extra buyers entering the market. It's the same, it's a pass-through of sales. Technically, you can have this it ranges between 2 and 7 months where this pattern is followed. Now, what would you expect to see if that's the case? Well, what you would expect to see is, since the sale year over year in last July, last August, and last September were not all 1,000 for the sake of the argument. So 100 sales on 1,000 would have been, that's a 10% gain. No. Those sales were already irregular. So what you have when the 100 sales extra gets reported in July, a month where there's more sales taking place, the increase is smaller. In August, where the sales were a little bit higher last year, the increase is a little bit smaller. And in September, when sales last year were again a little bit lower, it increases the sales, even though all you're doing is seeing 100 extra sales in July, 100 extra sales in August, and 100 extra sales in September. But what you read is a totally different story. You read a story about how the housing market has gotten busier over the last 3 months, when in fact, it's all a consequence of 100 extra buyers, first-time buyers, deciding to buy a home in June. This is the con that has been perpetuated on the Canadian public since the first days the Canadian Real Estate Association hired an economist in the 1990s. It is a con. Sales were not up 8% in Calgary in September of 2019, as the Calgary Real Estate Board reported. Their stats show that, but all you're actually seeing is the conclusion of what happens to the sales chain after an extra 100 buyers enter the market in June. The reason why you saw another decrease in the average selling price in September in Calgary, year over year, I think it's down about $13,000. The reason why it dropped was because there is no momentum in the market. The only momentum you hear is the sales pitch coming from organized real estate because of that 100 extra buyers who entered the market in June. Now, folks, you can go check the data yourself. It is on CRED.com, the Calgary Real Estate Board.com. The data is there. You can go see it yourself. Now, the question you need to ask as we leave the show today is, how is it possible all the real estate boards across Canada, all of the realtors across Canada, all of the economists across Canada, the Bank of Canada, the government of Canada, everybody who talks about a housing market, how come they didn't see that 100, 100, 100? How come they didn't see it? That's the question that we're going to leave you with until next week.
Ross, just briefly, isn't it deceptive when they use percentage terms to talk about whether real estate went up or down? Because if you only sold one house last month and 2 houses this month, that's a 100% increase. Isn't that deceptive?
You are my man, Jim. You are my man, Jim. If you track so when you work at a real estate board, you pick the local neighborhood that had the biggest change. So just in your case, if you lived in a neighborhood where only one house sold last year, but this year 2 houses sold, you'd report on that neighborhood, and you'd report 100% increase. If you have a neighborhood where there's 30 sales, and this year there's 33, you're going to report a 10% increase. You're not going to report about the neighborhood where the sales have slowed. And this has gone on for, like I said, for decades. I just can't understand how intelligent MBAs, PhDs, have not figured this out over the last 30 years. It's sitting right there in front of you. The Canadian Real Estate Association, the easiest place for them to get an increase is in PEI or Nova Scotia. That's the easiest place for them to get an increase because some little tiny change causes a big percentage to happen. And you got to remember, Jim, this also works on the downfall, on the downslide, and it works in reverse. It protects the realtor's message. Everything that you read about housing stats is simply, we can debunk it in 60 seconds. We can debunk it in the way that a grade 5 student who can do math understands.
Ross, thank you so much for being on the show.
Hey, thanks for having me on, Jim.
My guest has been homeownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.